Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, coming to you with the numbers for October, which cover till the end of September. These numbers I've really been interested in looking at because it's the first reflection of rates at a much higher level to see how all of that's playing out. You know, people have been, I see all kind of articles on, is there going to be depreciation? Is it like 2008? And so this is our first really look at how this is really starting to impact the market. So let's take a look here, and do me a favor, if you like the video, like it, subscribe to my channel. If you own real estate or want to own real estate here in Central Florida, not only do I look at the real estate market, mortgage rates, investment property, really anything that has to do with real estate, especially here in Florida. So let's jump into the numbers here. When you look, so there's the way they do this is they do year over year changes and month over month. Really, the year over year changes I don't really look at too much because rates were so much lower. The market was so different. But you can see here with just a quick look at 2021 rates, inventory is doubled. So that's obviously a 100% increase in inventory. But we'll see if that really matters. So if you look right here, these are the numbers I'm really paying attention to. So really month over month, not much big change in inventory, 1.8% increase. But here's some big changes right here. For the first time, we have seen some depreciation on our market. Now, not much, 3.6% and 3.4%, depending on if you're looking at average or median. And nationally, there have been some areas that have started to see a lot more depreciation. The key thing with depreciation is all markets are local. It's really going to depend on area to area how things are going to get affected as the Fed continues to push rates up. We'll come back to that here. Now, everywhere, and I mean everywhere, has really noticed a big drop in demand. Here in Central Florida, we're down 21% or so. That's really month over month and year over year. If you look right here, we did $1.4 plus million in volume, and we went down to 1.1 volume. I believe this is annualized. And you can see days on market went from 27 to 31. So the big noticeable changes here is that interest rates are up 20%, not a 20%, but a 20% increase, so 5.3 to 6.3. And then if you kind of jump in here to the main numbers here. So right now, let's just run down the list here. So average rate, and remember this was at the end of September, was 6.32%. Rates well over, high sixes to low sevens for highly qualified buyers. So this has continued to increase and will continue to impact the market. We have 6,884 homes on the market here, but really only 5,366 homes, single family homes, which is really low when you consider how big Central Florida is. That this is 912 condos, 606 townhomes. Look at the number of listings really dropping, 4,500 down to 3,300 listings. Now that's not really that surprising if you look at kind of, this time of the year that tends to drop, but that is a substantial drop. And if you look right here, 2,717 homes closed from 3324, and that's pretty low. I was looking back through here, and I don't remember if I remember seeing any sales getting that low. We had a couple in the beginning of January at 3,000, so this really is one of the lower sales close months in a while. And 31 days on the market is definitely really still low as far as timing, meaning you can sell your house in 31 days. That's still really fast, but that's an increase you can see from here. In June, it was 20 days. So those are all things that you would expect with what the Fed's doing. And then if we look at rates here real quick, you can see the big change in September. This time last year, 2.86%. Right now, 6.32%. That is a huge increase. And of course, that is what's really going on. So what does all this mean? What is the Fed going to do, and how is this going to impact our market really going through this year and through 2023? That is the million-dollar question. So what we know is this. Fed most likely not going to pivot till sometime next year. Even if they pivot, that'll just really be a pause. So we're looking at higher rates, in my opinion, for the next 3 to 6 months. Who knows what will happen after that? The bond market predicting lower rates, I kind of agree with that. But let's just stay for the next 6 months that rates are going to stay fairly high. We've already seen a lot of demand go off, the books as far as the amount of volume. We've been averaging over 6 million in sales. We're probably going to dip below 4 million in 2023. I believe that's kind of the consensus. So demand is falling, but at the same time, sellers are not listing their homes. You could see when I showed listings right here, listings went from 4,500 to 3,318. What does that mean? That's really creating a floor on prices. And whether you think that's good or bad, I'd love to see prices come down. If you think about what I do for a living, I sell hamburgers and I'd love to sell cheaper hamburgers. But the fact is that that's not happening. And the reason that's not happening is the Fed is going to keep rates high. Sellers have super low rates, tons of equity. There's just no reason for them to sell their house. And unless you believe there's going to be forced selling, then there's, which I don't see. In 2008, there was, massive unemployment. No one had any equity. People weren't that qualified. They were buying the houses and they were turning in these adjustable rates. And we have the exact opposite situation right now. And so there's just no way for that forced selling to come from. Unemployment's really low. What's likely to happen is that prices are going to stable. Now, that doesn't mean they're not going to drop in some areas. That's why you do have to know your local market. Florida, people are coming in from all over, so we benefit from that. Some other states do. States like California, really getting nailed about the amount of people that are leaving, and they are seeing some price depreciation. So it's going to be local to every market. But in general, I think most major markets, are going to see a fairly stable price with a little bit of depreciation. Let's call it 5%, maybe 10%. But really, you think we just had 15% this year. So that's really not much depreciation of any. And I think here in Central Florida, right now we're not getting hardly anything. You can see right there we had 3%. So I don't think you're going to see much there. What is the opportunity now? Well, if you're a seller, you still haven't missed a boat. You can still sell your house. You're not going to be able to get, most likely, way over asking price and a lot of the stuff that was going on. But if you sell your house at what the house will appraise for, work with the buyer, regardless of what the Fed does with rates, you're probably still going to be able to sell your house. If you're a buyer, unfortunately, you're waiting for prices to crash. What the numbers say is that's not going to happen. Now, I don't have a crystal ball and I can't give actual investment advice, but I believe that even though the market will soften, it's not going to be in the pricing. It'll probably be in the terms where you can get the seller to do things like 2-1 buy downs, which can lower your payment $500 or $600 a month for the short term, or maybe pay closing costs, or do other things to get in the house and give you a better deal. Because keep in mind, if you got the seller to lower the price $10,000, that only lowers the payment $60. So you're better off using that 10 grand lots of other ways, like lowering your cash to close or payment by buying the rate down or doing some of the other creative things you can do. What do I think is going to happen from here? Rates going to stay high, where they're at for the next 3 to 6 months. We're going to still see demand falling. I think we're still going to see listings falling. You're going to see those things equal each other out. I think if you're in a buyer, there is an opportunity because as soon as rates drop, and I just did a video where rates could be, some people predicting rates to be 5% next year. I don't know that to be true, but let's say they do drop. Say rates drop today, super low, everybody would jump in the market again and it would just drive prices up. So you really want to buy when it's in your favor. Obviously, you have to be able to qualify at the higher rates and find a house that fits your needs. But you want to buy now while there is less demand and then be refinancing when everyone else is jumping in the market. At least that's, to me, what the data shows now. We'll keep looking at the information. We're going to keep looking at days on market, sales closed, months of inventory, which is at about 2.5. If we get over that 5, 6, 7 month of inventory, then my view would change. I just don't see where that inventory is going to come from, especially as builders are slowing down as well and they're building less and less and less. So anyways, hopefully that's interesting to you. It's really cool to me to look at these numbers and see how much have changed just over the last 12 months. If you have any questions on this or anything else, let me know. As more information becomes available that moves the market, as always, you can find it here. Have a great day, and I'll talk to you soon. Bye.